Dustin, good to see you. Today we're talking about helping your favorite charity while reducing your taxes. But I have to just say, I love the Santa hat. Clearly, you're in a festive mood. What's going on?
I am. It's a festive time of the year. The end of the year is upon us. We're getting ready for our client Christmas party. And this is a great time of the year, not only for parties, but for giving back.
Yes, yes. Well said. So let's talk a little bit more about that because I know you're always thinking about helping your clients lessen their tax burden. You mentioned a good option for people who want to make large gifts to charity and also have large retirement accounts.
Right. Well, making charitable contributions, especially during retirement, one of the best ways you can do that is consider using your IRA. So
Mm,
let's think about it. An IRA account, any distributions or withdrawals you're going to make from that account, either an IRA or any other traditional pre-tax retirement account, you're going to pay taxes on every penny of those withdrawals. And if you don't spend those accounts over your lifetime, when your kids inherit those accounts, they're going to pay taxes on the entire account value as well. But
right.
there is someone who can spend some of those IRA monies and spend those monies with no taxes whatsoever. And that's your favorite qualified charity or church.
Right. Okay. And again, just to kind of underscore what you're saying, this all comes back to legacy planning and when we're trying to determine what we should be leaving our beneficiaries.
Right, that's a big part of it. So if you utilize your IRA, use withdrawals from your IRA to make your charitable contributions, that allows you to preserve some of your more tax efficient accounts. So, like for example, your kids are much better off inheriting a stock portfolio from you than they are if you leave them an IRA, because while they would pay taxes on the entire account value of the IRA, upon your death, if they inherit a stock portfolio, those stocks receive something called step up in basis. And what that means in a practical sense is those kids could sell those stocks shortly after your death with virtually zero taxes.
Mm, okay, that's an important consideration. Something else that you want to make sure though, that we all understand, it's really important to consider how we go about making these withdrawals because there are some very efficient ways to do it.
Right. So if you make the withdrawal yourself from that IRA and you give the funds to your favorite church or charity, you're not going to receive a tax deduction for that unless you itemize. And
Hmm.
even if you do itemize those deductions and receive, a tax deduction for that gift, you're still increasing your modified adjusted gross income, and that's something really important to avoid when you can. Because if you increase your modified adjusted gross income, it can put you in situations where you pay more taxes on your Social Security or you pay higher Medicare premiums. So here's a smarter way. Rather than you making the withdrawal yourself and giving the funds to charity, we can have the investment custodian make the withdrawal on your behalf, send it directly to your preferred charity or church. And that way, it's not included in your taxable income. There's no tax consequence to you. And again, there's no tax consequence to the charity. They get full use of those dollars. So, and here's the best part. If you're currently making required minimum distributions or RMDs, any qualified charitable distribution you make, that will satisfy your RMDs.
That's fantastic. That really is a win-win for everybody. Clearly a little bit complicated though. So if somebody would like to talk to you about how this works or whether it's right for them, what's the best way to reach you?
Sure, they can send me a text at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
All right. Dustin, Merry Christmas. Happy
Merry
holidays. Good to
Christmas.
see you.
Thanks a lot.